A very good morning, friends. So I hope everybody is doing good. And we were studying the concept of consolidation, and we have covered so far Index 103, which talks about business combination. Today we're going to start Index 110, that is consolidated financial statements. I think it's one of the core standard because in the examination, if you look at the frequency out of the standards on consolidation, invariably you'll see questions coming from Index 103 business combination or Index 110. A couple of things what we have done in Index 103 is also a grounding work in terms of Index 110. When Index 110 talks about specifically how do we make a consolidated financial statements. Now we've got a plethora of things to discuss, but of course I'm not going to scare you at the very start of the topic that what are the various agendas which we need to discuss. So what we're going to do, we're going to start off and kick off the topic with the scope of the standard. Because I know everybody of you who is past intermediate, of course you're past intermediate, is got some grounding work already done on consolidation, and you've all studied accounting standard 21, which is in ICAI. But there are of course a couple of differences in terms of accounting standard 21 and in terms of Index 110. So it's I feel that you're transiting from an IGAP which you've got almost to quite a comfort zone, and you're switching on to Index 110. So principally, I guess, 2-3 areas of differences, which I must tell you at the very start. Because I think one thing which we need to keep in mind, because a lot of things will keep coming to your mind, that this is what I did in accounting standard 21. Is this equally applicable in terms of 110 or not? So let me at the very start give you some grounding work in terms of some major differences which are there in terms of AS 21 and 110. I'm not going to give you all differences, just 2-3 major differences which you need to keep in mind. Now, so let's start with, first of all, a basic difference which is there in terms of the IGAP. When I say IGAP, I'm looking at the accounting standard 21. That's what we call IGAP, Indian GAAP. And in terms of Index, we've got Index 110. Now, I would, first of all, kick off this part that if somebody were to ask me, tell me some core differences between the IGAP and the Index, I would say the first core difference is with regard to control assessment. The first one is with reference to, I would say, control assessment. So we can say that in terms of IGAP, the control assessment is basically, you can say, rule-based. It is basically a rule-based assessment. Now, what does it mean that when I say it is a rule-based assessment? Generally, we used to say that if you've got more than half of the voting power in a company, you control the company. Of course, there are other parameters with which you make an assessment of control, like for example, having a control over the composition, majority composition of board of director. But I guess if you look in terms of the voting power, generally we say that if you've got 50% plus, we are not saying it is 50, we are saying if it is a 50% plus voting power, in this particular case, we can say, yes, generally the control is present in this particular case. But as far as Index 110 is concerned, the control assessment is not at all a rule-based assessment. It does not depend upon typically a percentage. Yes, the chances are bright that if you get more than a 50% voting power, you would definitely prove that there is a control, but it is not a rule-based assessment. So I guess correspondingly, if I were to say in terms of Index, I would say it is largely a principle-based assessment. It is largely a principle-based assessment. And here, when I say principle-based assessment, it is a lot of application in terms of judgment. Surprisingly, let me Index 110 text Trust me, if you're going to make a scrutiny in terms of the principle, nowhere does it make a mention about any percentage. The assessment of control is given on the basis of certain factors, and that is like power. And they talk in terms of exposure to variable returns, etc. So there is no guidance in terms of any percentage which is given. It's completely a principle-based assessment, and it could involve judgment, which means, is there a possibility that you get more than 50% stake and there is no control? Yes. Is there a possibility that you've got less than 50% stake and still you get a control? Yes. That means the judgment-based assessment could lead to some very interesting results. So we can say that there could be a control even if it is below 50. There may not be a control even if it is more than 50. And this, also gives rise to a very interesting level of discussions as well. When you compare this position under the Companies Act as well, under the Companies Act also, more or less, you can say the assessment is again rule-based. The ICAI and the Companies Act more or less considers a rule-based assessment. So there is going to be a conflict. There is going to be a conflict in terms of making an assessment of control. So we're also going to talk in terms of that if there is any contradiction in terms of the control assessment as per 110 or as per the Companies Act, then what are the kind of clarifications which is given by the Accounting Standard Board of ICAI? There is an educational material that is dealing with Ind AS 110, and I'm going to pick up a few case studies from there just to give you a clarity of thoughts. So that if there is a contradiction in terms of the Companies Act, then which are we going to follow? We'll go to talk of that later. That is one. Second, the second very interesting, I would say, difference is in terms of, you can say, cases where consolidated financial statements are not required. Cases where the consolidated financial statements are not required. Interestingly, if you look at Accounting Standard 21, there were two cases where the company is told that you need not consolidate. One of the cases is that if you've got more than 50% stake, it's a temporary investment. And the second case is where the subsidiary is operating under severe long-term restriction on transfer of funds to the parent company. Consolidation should not occur. So I'll not get into the details of what those kind of exemptions were, but they've given two kind of cases where consolidations is not done. When your investment is temporary in nature, now I would like to, give you a little good insight at this stage. Watch this carefully. So one of the exceptions they've given is that it is supposed to be a temporary investment. It talks about that consolidation is not going to be done if it is a case of a temporary investment. Now, hear this carefully. If you look at Ind AS 110, this exception is not there. Now, you need to see this very carefully. I have not seen any question on this area which I am about to tell you, at least in the examinations or in the study. But this can be a very interesting area of questions. Of course, I have seen questions on that area as well, practically as well, but I'm not going to dwell upon that discussions. But in this particular case, when it is a temporary investment, consolidated financial statements is going to be prepared, and this is going to be prepared in accordance with Ind AS 110 as well as Ind AS 105. When you say that you've acquired an investment which is temporary in nature, then you should call that investment as a non-current asset held for sale. I'm sure you've done Ind AS 105, which talks about the concept of NCA held for sale and a discontinued operation. So in this particular case, there is a clear-cut insight which is given that in terms of Ind AS, if you find that there is a case where you acquired a subsidiary with a view to subsequent disposal, we can say it is a temporary investment. You acquired a control of the company, but the intention is not to keep the investment. The intention is to dispose of the investment in the future. So Ind AS 110 requires you to consolidate, but of course the consolidation presentation is going to be done in accordance with Ind AS 105. That's a very interesting difference as well. The second exception, I don't want to get into detail, but I'm just making a reference to the second exception as well. The second exception is where the subsidiary is operating under long-term severe restrictions. So where we can say that the subsidiary is operating under severe long-term restriction on transfer of funds. Even this kind of exception is not there in terms of Ind AS 110. So moral of the story, I guess what I've given you so far in terms of the transition, I've given you the insight that what you were doing at the intermediate stage and what you're going to do at the final stage. So I created a little grounding work at the back of your minds. So there are two major differences. I'm not saying this is the only list of differences. We are saying that there are more differences in terms of 110, a lot of differences, but just for your basic understanding, I'm looking at two differences that when you look at the ICAI, in that particular case, the assessment is a rule-based. Even under the Companies Act, it is a rule-based assessment. But when it comes to the Ind AS, it is a principle-based assessment. So there could be a conflict in terms of control assessment under the Companies Act and under the Ind AS 110. So in this particular case, what are the clarifications? We're going to watch them carefully. The second area is that Accounting Standard 21 allowed cases where companies were not required to consolidate. So one of the cases was that if your subsidiary is operating under severe long-term restriction on transfer of funds to the parent company, consolidation was not required. The second exception is that as far as the investment in subsidiary is concerned, it's purely temporary in nature. But Ind AS 110 does not give you these two cases. It says, no, you need to consolidate. Even if your subsidiary is operating under severe long-term restriction to transfer the funds to the parent, it doesn't make a difference. And the interesting clarification is that if you've got a temporary investment, remember, consolidation will be done, but it is going to be done the way it is presented under 11105. It's going to be called as a non-current asset held for sale, and the subsidiary is going to be called as a discontinued operations, and the balance sheet consolidation of the income statement and the balance sheet will look like something what looks under Ind AS 105. Consolidation will be done, but the technique, the presentation of the consolidation will take the shape of 105. I hope, friends, you got the initial clarifications clear. Okay, so I think let's begin the journey with these two inputs in hand. And I want to first of all take you to the insights in terms of the very first classification. Having given you this particular inputs, I want to now first take you to a simple clarification which is given in the education material. This was with reference to the discussions which we just did, that there could be a contradiction in terms of the Companies Act and in terms of Ind AS 110. So let's see if there is a contradiction. What is the clarification? This is what I've taken from the education material under Ind AS 110. Let's read the inputs. Ind AS 110 consolidated financial statements as well as the Companies Act requires company to present a consolidated financial statements. However, under both the regulations, the criteria for determining the relationship with other entities are different. As I've already said, rule-based and principle-based assessment. Whether a company should follow the requirements of Ind AS or the Companies Act 2013 for the purpose of preparation of financial statements. So there is a possibility that under the Companies Act you say that it is a subsidiary or it is not a subsidiary, and Ind AS 110 takes a different view based on a principle-based assessment. So now let's look at the clarification. There is a rule number 4A of the Companies Accounts Rules 2014 issued by the MCA, Ministry of Corporate Affairs. And this is what is stated in the rule number 4A. So I'm just reading what is the inputs given in rule number 4A. It says financial statement shall be in a form specified in the Schedule 3 to the Act. That means we are looking at, in our case, Division 2. The financial statements needs to be prepared in the format which is given in Division 2 to Schedule 3, and it should comply with the accounting standards or the Indian accounting standards as applicable. Of course, we're making a reference to Division 1 as well, but in our course, since we are focusing on Division 2, so I said format as per Division 2. So very clearly it says format as per the Schedule 3, Division 2, and it should comply with the Indian accounting standards. Provided that the items contained in the financial statements shall be prepared in accordance with the definitions and other requirements specified in the accounting standards or the Indian accounting standards, as the case may be. So it says that when you are going to make the consolidated financials as per the format which is prescribed under the Companies Act, in this particular case, we need to consider the definitions and the requirements which are contained in the Ind AS. Thus, it is evident from the above that for the purposes of preparation of financial statements, the definitions and other requirements given under Ind AS will be considered and applied by the entity. Accordingly, a company should follow the requirements prescribed under the Ind AS 110 for the purpose of preparation of financial statements. So this particular question gives us clarification that when you are looking at the control assessment, I need to go with the guidance which is given in 110. Even if the Companies Act says, no, it's not a subsidiary, it is logical to consider which is also given as a part of the clarification. So I'm going to take you to another interesting one, though certain things which you're going to see in this question is something which we have not yet discussed. Because he'll talk in terms of the clarifications regarding the control assessments. Don't get worried on that part as of now. This is question number 2, which is again picked up from the education material. It says AB has got majority voting shares in several company, and all of these investee company qualifies as subsidiary within the meaning of the Companies Act 2013. All of these investee company also qualify as subsidiaries of AB within the meaning of Ind AS 110. So it says since all the decisions taken are on the basis of simple majority of votes. So majority of the investee companies are meeting the definitions under the Companies Act as well as Ind AS 110. Now he gives you a little exception. AB has got a 48% voting shares in Z. As AB neither controls the composition of board of directors nor it exercises or controls more than half of the voting power, therefore Z does not qualify as a subsidiary under the Companies Act 2013. The Companies Act 2013 has given us a guidance in terms of more than half voting power and or you can say the case where you are controlling the majority composition of board of director. Considering a 48% stake without controlling the majority composition of board of directors, it does not qualify to be a subsidiary under the Companies Act. The voting rights in Z, other than those held by AB, are held by thousands of shareholders, none of which has got more than 1% rights. We will see later when I come to the specific discussion on a control assessment that, as a single majority stakeholder, I may have a 48% stake in the company and all other shareholders are, got not more than 1%. So if you compare my relative size of the investment as compared to the other investors, in that particular case, I'm big. Because I may be below a majority, almost a close less than majority, but still my percentage is so high that if you compare my investment with the other investments, relatively I am a bigger investor. So in those cases, under Ind AS 110, there is a possibility that you can get a control. So that's what it says. It says the voting rights are held by AB, and other than those thousands of shareholder, none of which has got more than 1% voting rights. So that everybody is too small an investor in front of AB. Then he says none of the shareholders have got any arrangements to consult any other. On the basis of the relative size of the shareholding, AB determined that 48% is sufficient to give a de facto control. With this is called a de facto control. It's I always tell people a phrase, it's like andho mein kana raja. And where I always tell people that, if you compare your size as compared to the other investors, you are big. And if you're big, you could get a control. That's called a de facto control within the meaning of Ind AS 110. Consequently, Z qualifies as a subsidiary. In preparing the financial statements as per Ind AS, should AB also consolidate Z or not? Now, in this example, you can see the contradiction very clear. The Companies Act is saying the consolidation will not take place because it's not a subsidiary, but Ind AS is saying it is a subsidiary. So as per the rule 4A, what we have seen, we will do the consolidation. So again, the rule number 4A is quoted. I'm just going below. Thus, it is clear from the above that for the purpose of preparation of financial statements, the definitions and other requirements which are given in Ind AS is applied. Z qualifies as a subsidiary and it should also be consolidated in preparing the consolidated financial statements. I hope, friends, I have given you the insights now on the clarification. So what we have covered so far, we have covered one basic principle which I started off with. ICAI talks of a rule-based assessment. Companies Act talks of a rule-based assessment. Ind AS talks of a principle-based assessment. And if there is a contradiction in terms of the Companies Act and in terms of Ind AS 110, the clarification given in the education material clearly tells us that rule number 4A is very clear that when you go to make a consolidated financial statements, the definitions and other requirements of Ind AS 110 is going to be taken as guidance. So in the example we've seen, the Companies Act says not a subsidiary. The Ind AS says it is a subsidiary. Consolidated financial statements need to be prepared. You are going to consolidate that subsidiary. I think let's pen this down as well. So moral of the story. So let's put down the moral of the story at this particular case. So what I'm giving you so far is clarification notes. What I've given you is a clarification notes. As I said, I'm moving you on a transition phase from the ICAI understanding to the Ind AS 110 because you've all done AS 21. And sir, please tell us one thing at this stage. Is our technique of consolidation, what we have learned in terms of intermediate, is that going to be the same under Ind AS 110? Maybe yes. But of course, friends, let me tell you, I am going to give you a wonderful technique of consolidation, which is again going to be based on a step-by-step approach. And that particular technique could be, different as compared to what you have done at the intermediate stage. So I would say that learn the technique with an open mind because it might contradict with your techniques as well. And I'm going to give you a technique which is very simple, but sometimes the problem becomes that when you're used to, some doing tougher things, somebody comes and makes your life simple. You may not like it. I've seen, when you make people life simple, they don't love it. They don't accept the idea of the change that somebody is making a life simple. You still feel kuch to gadbad hai they are. Okay, that we'll see later. So in this particular case, when I'm looking at the clarification notes, the first one is when you look at the Companies Act, when you look at the Companies Act 2013, when you look at the Ind AS, I'm not talking of ICAI because the focus is not the ICAI. So when you're looking in terms of the Companies Act, it is basically rule-based. And this is basically principle-based, as we said. So the assessment is going to be principle based out here. So which means that in this particular case, if there is a contradiction, if there is a contradiction, so if there is a contradiction, then we need to apply the definitions and requirements. We need to apply the definition. So we need to apply the definitions and other requirements. Let's underline definitions and other requirements. So we need to apply the definitions and other requirements of Ind AS. And as I said, this is the inputs which is given in rule number 4A. So this is the inputs which is given in terms of rule 4A of the company's accounting standards. Let's not put this name of the rule, that's fine. It is given in rule 4A. You can say of the company's, let's put the reference as well. It is supposed to be company's accounting rules, company's account rules 2014. So if somebody at least puts across that question, you know that rule 4A of the company's rules 2014 gives you this clarification. So let me just also add on. So we can just add on out here that as per the Companies Act, we decide that a particular investee is not a subsidiary. But in terms of the Ind AS, we says, yes, it is a subsidiary. As we saw in the question number 2, in this particular case, the conclusion is it will be consolidated. So it will be consolidated in this particular case. The reference goes to the question number 2, which we have done. So that was one interesting clarification under the Companies Act and compared to the Ind AS position, that if there is a contradiction, you need to go with the requirements laid down in the Indian accounting standards and the consolidations will happen. Wonderful. Now, second clarification, which I've already given you, I would just like to add it out here. When I started my journey, I gave you that exception as well, but I just want to add on that inputs as well. So let's put another clarification to you. So we're looking at a case of a temporary investment. I'm looking at a case of a temporary investment where I want to give you the basic difference between the ICAI as well as in terms of the Ind AS, which I clarified, but trust me, it's a very interesting, important clarification. I would love to see a question on that area, where there is a subsidiary which is classified as held for sale. How would the consolidation take place under 105 coupled with 110? Beautiful to see. So when you're looking at a temporary investment, we're looking in terms of ICAI, that is Accounting Standard 21. And we're looking in terms of Ind AS 110. So the clarification, which is again given in the education material itself, this clarification which I gave you is again given in the education material itself, that in terms of ICAI, there is no consolidated financial statements. In terms of Ind AS 110, consolidated financial statements will be prepared. It will be prepared. But I want to just make a clarification. The subsidiary will be classified as, non-current asset held for sale and discontinued operations. Underline that it will be classified as NCA, held for sale and discontinued operations, and therefore, so we can say it will be consolidated. It will be consolidated. It will be consolidated. And let me put it like this, that it will be consolidated as per the procedures. It will be consolidated as per the procedures of Ind AS 110, but it will be presented. It will be presented as per Ind AS 105. So this is something which can be very interesting to watch. That the consolidation will be done as per the procedures of 110, but it will be presented as a consolidation technique 105. 105, you know that it's going to appear as a single line item which appears in the balance sheet, NCA held for sale. Okay, so far so good. I've just given you the two important clarifications which you need to know in terms of the contradiction between the Companies Act and even if it is a temporary investment. And when I say temporary investment, let me also put down something at this stage. The temporary investment means that it is acquired. That means it is acquired with the intention. It is acquired with the intention of sale, with the intention of resale in future. So you acquired a control over the subsidy which is temporary, but it is acquired with the intention to make a resale in the future. Consolidation will take place. Interesting. Now, I guess I'm going to take it forward. Having given you these clarifications, I want to now take you further on the interesting discussions. The next area of my discussion now at this stage is the scope of the standard. So before we come to the control assessment, we're working on the basics. We're working on the basics at this particular stage. I'll just let you know now what is my sequence of thoughts. I'll just give you the insights in terms of how we are going to take our discussions forward. I've started my inputs with some basic clarifications and I'm going to discuss the scope of the standard. There are a lot of questions, sorry, there are a lot of questions which are given in the study material, which is based on the scope of the standard, where they're talking about whether consolidation will take place or not. Somebody, you just said that under Ind AS 110, there is no such exceptions. No, there are. But those exceptions are not like temporary investments. There are clarifications that in these cases, consolidated financial statements may not be prepared or are definitely not required to be prepared. Mind the words. So we're beginning our discussions with the clarifications and the scope of the standard. Once that area is done, then we'll go to the next area, which is a control assessment. How does the principle-based framework work in terms of deciding the control is present or not? After that area is done, I'm going to go to the next area in terms of how the consolidation occurs. And once we're done with the area of how the consolidation occurs, we'll go to another area. And that is called the change in the ownership interest in the investee. You're moving from, let's say, a situation of a control and it becomes an associate. Or from a control, it becomes a passive investment. Or simply, you made a disposal of the company. So what happens when there is a change in the ownership interest of the investor? So basically, my entire discussion is going to focus in terms of 4 areas with you. I'll divide this entire standard in terms of 4 agendas as we move. So when you're going to make a revision of the standard, keep this in mind that there are a total of 4 focus areas. My focus area is on the clarifications and the scope of the standard. Second is on the control assessment. Third is on the control technique. That is, how are you going to consolidate? And the fourth one is the changes in the ownership interest. When there is a further acquisitions or there is a disposal, and the status of the investor company in the investee company could change or may not change. Then what happens if there is a change in the ownership interest? Of course, in between there could be some kind of value additions to each of these 4 areas. So this chain I've given you because as we're going to move on to the consolidation, you need to be very clear on the movement of the standard. So let's begin with the scope of the standard now. Now watch this carefully because this is what we're going to discuss at length. Remember when you were in intermediate and when you used to study consolidation, you used to reach the consolidation technique in almost like 15-20 minutes or half an hour's time. Oh my God. Today, we're going to spend almost entire class understanding the scope, the clarifications, the control assessments, and even that would go on for the next class a bit as well. So you're going to see a lot of conceptual knowledge which you're going to get. You would have understood and realized so far, Indes is not like ICAI. There is a lot of application of judgment. There is a lot of application of principle-based guidance, which you need to absorb and which is applied in a practical world. So I guess the technique, when we used to study at the intermediate stage, it was more like doing questions. It was more like, you get a particular question, you put a journal entry, you record it in the ledger accounts, etc. Now you've seen a huge transition change in terms of financial reporting. The entire thought process of the studying the subject is undergone a change. It's more like, a taxation kind of a subject, where you're first looking at the basic principles and the rules which governs the accounting. And then you're applying all those to the specific cases as well. I think you would have already realized it so far that there is a huge transition change in terms of the approach. I think you'll agree, right? Okay, let's take it further. So let me now read what is given in the para number 4 of the standard. I'll explain the inputs to you, no worries. It says an entity that is a parent shall present. The word shall is indicative that it is mandatory in nature. It shall present consolidated financial statements, and this index applies to all the entity except as follows. So we are given what is called exception. This is what is called exception. So let's see what are the exception. Now it says a parent need not present. The word is it need not present. When I say that a parent need not present, it is not something which I am mandating. It is something which I'm giving them a choice. The language is very clear. A parent need not present. That means I'm giving them a pure choice. If they want to consolidate, I'll not stop them. But if they don't want to consolidate, they get a choice that they may not consolidate. So it says a parent need not present consolidated financial statements if it meets all the following conditions. So you need to meet all the conditions. So there are 4 conditions. If you meet all the 4 conditions, your choice, you want to consolidate or not. You fail any one, you need to consolidate. Don't worry, we'll pen down the notes later. Now let's have a look at these conditions. But before we have a look at these conditions, it is important to map something in the back of the mind. Let me caution you, friends, as I'm going to go ahead with the scope, you might start getting a confusion almost after around half an hour's time. But don't worry. I will consolidate things at the back of the mind with such a clarity that you will get a grip on the scope of the standard. We do a couple of illustrations and examples as well. Now, let's keep one thing at the back of the mind. There is a company A, there is a company B, and there is a company C. So when you're looking at the para number 4, one thing what you need to keep in mind is a chain holding. When you're looking at the para number 4, in terms of the para number 4, you need to keep in mind that there is a chain holding. The para number 4 does not apply to a normal case. This applies only when there is a chain holding, that's one. And secondly, the focus of para number 4 is in terms of the middle company. The focus is in terms of the middle company. So please keep this in mind. As I read the para number 4, my focus is that I'm trying to see, can I tell B, it's your choice you want to consolidate or not? I'm not focusing on A. We're focusing on the company which is in the middle of the chain. The chain could be longer, let's not get into that. But the focus in terms of para 4 is in a chain holding, we're looking at the middle company. If it is able to fulfill all the 4 conditions, we give them a choice. So let's keep that in the background and let's read. It means B is a wholly owned subsidiary or is a partly owned subsidiary of another entity. The question number one, which you're going to put across to yourself is B a wholly owned subsidiary of A? Yes, condition one met. Please mind the words carefully. So I'm going to put across the question number one, is B a wholly owned subsidiary of A? If you say yes, the condition number one is met. I put the question number one again, is B a wholly owned subsidiary of A? I say no. I say, okay, it is a partly owned subsidiary. That's still okay. But then if it is a partly owned subsidiary, then there is a condition, and all its other owners, including those not entitled to vote, blah, 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 have been informed and do not object to the parent not presenting a consolidated financial statements. So there are two cases in terms of the condition number one. The condition number one has got, you can say, two situations which can arise. Number one, if B is a wholly owned subsidiary of A, the condition one is met. If B is a partly owned subsidiary of A, I will say, okay, let me inform the other owners. Let's say, for example, A is got in terms of B 80% stake. So that 20% stake belongs to somebody else, and what you call minority interest in ICAI, we're going to call this as NCI, non-controlling interest in 110. What we used to call as MI, minority interest, is called NCI, non-controlling interest in Indes 110. So we will say, okay, if B is a partly owned subsidiary of A, then tell me, have you informed the other stakeholders? That means, have you informed the NCI and they've got no objection to the fact that if B does not make a consolidated financials? So in this particular case, we can say, it says all other owners, including those entitled to vote, have been informed and they do not object to the parent not presenting console. In fact, let me just clarify, I should not take this 80% here, I should take this 80% here. So let's say, for example, B has got 80% stake in C. So we'll say that 20% belongs to the NCI. Did you inform the NCI? And they did not raise an objection in terms of not presenting console. They're okay with the fact that B does not prepare a console. If yes, the condition one is met. So now let's read the inputs. B is a wholly owned subsidiary, or B is a partly owned subsidiary, and all other owners would mean NCI. They have been informed and they do not object to the parent not presenting console. So the condition number one is simple. I'll look at the condition number one from the B's point of view. Is B a wholly owned subsidiary of A? Yes, go to condition two. If B is a partly owned subsidiary of A, let me see, is the NCI informed and they do not object to the fact that B does not prepare a console? My condition number one is met. I hope you got the point. Let's go to the next one. Its debt or equity instruments are not traded in a public market. Basically, we're saying that the debt equity investments of B is not listed. B is not a listed company, because when you're saying that its debt or equity instruments are not traded in a public market, that means it is not a listed company. And I think the logic of putting this clause was that if B is not a listed company, there is no public stake. And then I think the very fact of consolidation not being done doesn't scare people. You know, we are more worried about the fact that if B is a listed company, I would never give him an exemption. Because in this particular case, the idea is that if B is unlisted company, we're still okay with the fact that if consolidation is not done, because public stake is missing. But if B is a listed company, undoubtedly it will never get any exemption. Then it adds on. That means B did not file, nor it is in the process of filing its financial statements with the Security Commission or other regulatory organization for the purpose of issuing any class of instruments, which means it is not even in the process of getting listed. The condition number 3 is that it is not even in the process of getting listed. So the condition 2 is that it is not listed. The condition number 3 is it is not even potentially listed. That means it is not in the process of getting listed as well. And then comes the interesting 4th condition. It's ultimate or any intermediate parent. Now let's see who is the ultimate parent. Can I say in this chain, I would say A is the ultimate parent. On the top of the chain is A. So A is the ultimate parent. The chain could be longer as well. For example, if I consider A and B, B and C, and C and D, I would say from C's point of view, B is the intermediate parent and A is the ultimate parent. So when you look at C, you can say B is the intermediate parent and A is supposed to be the ultimate parent. The company on the top is the ultimate parent and anybody in between is the intermediate parent. So it says its ultimate or any intermediate parent produces financial statements available for public use, and they comply with Ind AS in which subsidiaries are consolidated or measured at FPTPL. I'll not get into that FPTPL at this stage. So the 4th condition is that in this particular case, if I want to give a choice to B, I'll say, okay, tell me, is A making financial statements for public use? 1. And it is making financial statements in accordance with the Ind AS or not. So what is important is that it is indirectly a listed company. Because if it is preparing the financial statements for public use, that means A, the ultimate parent, is supposed to be a listed company. And number 2, it should follow Ind AS. Because it should be presenting a consolidated financial statements. Now get this logic. If A is supposed to be making consolidated financials, he would consolidate B and C both. And if A is consolidating B and C both, then I think I can definitely tell B that you may not consolidate. Why should there be duplication? If I tell B to consolidate C, one set of console. I tell A to consolidate B and C, another set of console. If A is already consolidating B and C, and I feel that B is not listed nor in the process of listing, and everybody is agreeable to the fact that he doesn't present a console, why tell him? It's his choice in that particular case. So this is the 4 conditions which are there. Now quickly, let's recap these conditions with you. So what is going at the back of the mind in terms of the 4 conditions is, let me put them down. I'll document those inputs as well. But there is something more in terms of these conditions which I did not show you intentionally. But I will show you that part later through a question. Let's see what is your observations on the languages as well. So let's come to the inputs in terms of this. Number 1. Get one fact very clear, that para number 4 applies only when there is a chain holding. That's one very important input. If you look at a sequence where A has got a control over B and there is no C, para number 4 cannot apply. The para number 4 is applicable only and only if there is a chain holding. Let's get that clear. And the para number 4 would apply basically to the middle company. So when I give you a situation, there has to be a chain holding, otherwise para 4 cannot apply. And in the chain holding, the focus is on the middle company. That's one. Second, I'm giving a choice to B. I'm not mandating him. I'm not dictating him. I'm not saying that you cannot make a consolidation. I'm saying teri marzi. You fulfill the 4 conditions. You don't want to consolidate, don't. You fulfill the 4 conditions. You want to consolidate, please go ahead. I don't have a problem. So what are the 4 conditions? The condition number 1. The first and the simple condition is B is not a listed company. The second condition is that B is not in the process of getting listed as well. The third condition is that B is a wholly owned subsidiary of A, or B is a partly owned subsidiary of A and the other. And you can say the NCI, the other investors have no objection. They've been informed and they agree with the idea that we don't have a problem if B does not make a consolidated financial statements. Next, the next input what we're looking at is the fourth condition. The ultimate parent or any intermediate parent in the chain is, first of all, a listed company. It's making financial statements for public use, and then I will tell B, you've got a choice, you want to consolidate or not. So I hope, friends, I am very clear on the main points in terms of what are the conditions when para 4 applies, and para number 4 is not mandatory, but it is a choice, and what are the 4 conditions. Let's document them to you. Let's document this part to you. We'll come to some more inputs as well, but let's first of all document this part. So I am coming to my section number 1, where I am working on now the scope of the standard. I'm working on the scope of the standard in this particular case. So my focus is in terms of para 4. You need not know the para number, but I just want to keep a reference in my discussions today, because as I go ahead, I'll remind you that this was the para number 4. So in terms of the first and the first most important thing is para 4 applies when? When does para 4 applies, or when does it trigger? So you need to keep this in mind that para 4 applies when there is a chain holding. When there is a chain holding. So this is one focus point, that para 4 will apply only when there is a chain holding. If there is no chain holding, the chain holding is A in B, B in C, there has to be a chain. So this will apply when there is a chain holding, number 1, and it applies to middle company. And it applies to the middle company. In the brackets, let me make a mention, not to top company. In my example, company A was the top company. It does not apply to the top company, it applies to the middle company. This is one thing which should be crystal clear in your mind, that para 4 will apply to the middle company. Para 4 applies when there is a chain, otherwise it does not get triggered. The next input which you need to keep in mind is that when you're looking at para number 4, it gives a choice. It gives a choice. So this is something which we can say that it gives an option. It is not mandatory. So let me put it in the brackets. It is not mandatory in nature. So it gives you a choice. It is not at all mandatory in nature. So let me just also put it down that middle company, if it meets all 4 conditions, may prepare a consolidated financial statements, or may not prepare. So it may prepare or it may not prepare a consolidated financial statements. It's a pure choice. I'll come to more clarifications also very soon. Right, friends. So this is the 2 things which you need to keep in background. That when does the para number 4 trigger, and the para number 4 is a pure choice. It does not mandate you. You want to make a console after meeting 4 conditions, you can. Now let's see the 4th set of conditions. So we are now going to look at the 4 conditions in simple terms. What are we going to look at? So I guess I am going to put the 4 conditions in short. Condition number 1. The condition number 1 is, I'll take the same example, B, there are 2 possibilities, is a wholly owned subsidiary. B is supposed to be a wholly owned subsidiary of A. So your first condition is that B is a wholly owned subsidiary of A. That's one. Or, I'm putting the word or very clearly. B is a partly owned subsidiary of A. So B is supposed to be a partly owned subsidiary of A. But if it is a partly owned subsidiary of A, then you need to meet other conditions as well. So there is another condition as well, and that is the NCI has been informed, the NCI has been informed and has, so let's underline informed, and has no objection. Underline no objection. So NCI has been informed and it has got no objection to be not presenting CFS. They have got no objections for B not presenting a consolidated financial statements. So that is condition one. You'll see either this or this. If it is wholly owned, condition one met. If it is partly owned, just look at the NOC part, the no objection certificate part. I mean, don't take it literally as a NOC. It is only that they've been informed and they've got no objections. Then we go to the condition number two. Then we look at the condition number two, and condition number two is B is not a listed company. B is not a listed company. The condition number three is similar. So in terms of the condition number three, we are saying B is not in the process. B is not in the process of getting listed. So B is not in the process of getting listed as well. So neither it is listed nor it is in the process of getting listed. I call this as potentially listed company. We can short call it as a potentially listed company. So neither it is listed nor it is in the process of getting listed as well. And then there is condition number four. And then there is a condition number four as well. And the condition number four is interesting. Ultimate parent. Ultimate parent, in my example, the ultimate parent is supposed to be A. So ultimate parent A is presenting consolidated financial statements as per Ind AS. That is like condition one. So ultimate parent A is presenting consolidated financials as per Ind AS plus for public use. So it is basically a listed company. It should be presenting things in accordance with the public use. Right, friends, I hope I am clear in terms of things. So this is the inputs, the four conditions which we need to keep in mind. So the condition number one is regarding the percentage stake, which A is got in B. Second and third is B is not listed, nor in the process of listing. And the fourth is that somebody on the top of the chain, the ultimate or the intermediate parent, is following Ind AS, making console, and it is making for the public use as well. Right, friends, so far so good. I hope I am 100% clear in terms of the para number four. You need to be clear on the conditions attached. When does para 4 trigger? You need to be clear in terms of the conditions that even if they're met, it is still giving you a complete choice of consolidation. Wonderful indeed. I think at this stage, let's maybe pick up a small little case study with you. So let's, I think, pick up a small little case study at this particular stage. So we're going to see a simple little case study at this stage. I have a question which is there in the education material as well. Or maybe we can add something first more and then go to the inputs. Yes, we can. Okay, I think let's do the questions later, because once we are doing the questions, we should get more data as well. So let me take you to some more inputs at this stage. We'll go to some more inputs at this stage as well. Let me just also take you to another relevant para as well. Let's have a look at another case as well. I think we'll do the questions, consolidated, because if we get more data, we can think a little more better in that case. So let's have a look now at another case, which is the para number 4B. I'm looking at the para number 4B now. It says a parent that is an investment entity. The very first question arises, a parent that is an investment entity. What is an investment entity? I think we'll not get into details at this stage that what is an investment entity, but let me just give you some basic insights on what is an investment entity. Just a very basic insight. There are certain investors who give money to my company. So I've got certain investors who want to earn returns. So they give money to me as an entity. And I am basically making further investments in other company with the entire objective of earning interest dividends and getting a capital appreciation, something similar to what you call investment property. The essence is quite similar. So what is happening that me as an entity, I have certain unrelated investors who give me the money and they interest me that I'm going to park that money in other companies with the sole objective of getting them capital appreciations or getting them interest and dividend income. And therefore, if certain parameters are met, I'm saying if certain parameters are met, I would be called as an investment entity. So the role of the investment entity is to act on behalf of certain unrelated investors. These unrelated investors pump in money to me, and I use that money to make investments in other companies. And when I make these investments in other company, I may achieve a control over those companies. But my objective is not to get a control otherwise. My objective is a control which has come by default. Because I am basically working on the objective of growing the value of these investments. So in this particular cases, does it make logical sense that as an investment entity, I am told to consolidate those companies? No. Even in terms of investment property, though Ind AS does not allow you in terms of Ind AS 40, internationally these investment properties are taken at a fair value. Ind AS 40 is only telling you to take investment properties at a cost model. But if you look at IS 40, it allows you to take the investments at a fair value. Because if you're investing in properties with the objective of earning a rental or with the objective of getting a capital appreciation, you need to capture those investments at a fair value. So considering the international accounting, the same concept applies for an investment entity. The unrelated investors gave me money and I park that money in certain companies where I get a control by default. But my objective is not to get a control. I'm not working on the objective of achieving a control. So in those particular cases, the standard says, why should you consolidate? It is better that you present these investments in the balance sheet at a fair value. So they have given this as a mandate. It's not a case of choice. If I am an investment entity meeting certain criteria, I am mandatorily required not to consolidate the companies where I get a control. Now, what are investment entities in particular? There is a lot of guidance which is given in the standard and it's covered very largely in the study material as well. We'll talk of that later. So now with this background read, a parent that is an investment entity, company which is investing in other companies on behalf of the unrelated investors with the objective of getting a capital appreciations or return. Shall not, when I say shall not, it is supposed to be mandatory in nature. It is not giving a choice. It is telling them you cannot consolidate. So it says, shall not present consolidated financial statements if it is required in accordance with para number 31 of this Ind AS to measure all the subsidiaries at a fair value through profit and loss account. We see that para number 31 as well. But now let's get another thing very clear, friends, at this stage, so that no confusion comes up at a later stage. Can this para 4B apply to a case which is not a chain holding? Yes, it can. Can it apply to a case where there is a chain holding and it can apply to company A? Yes. Can it apply to company B? Yes. So once again, para number 4 is applicable only when there is a chain to the middle company. Get it straight. Para number 4 is completely a choice. I'm giving you a distinction between the para number 4 and the para number 4B. So what is the distinction between the two? The para number 4 is applicable when there is a chain holding and it gives you a choice. The para number 4B is applicable when there is a chain or there is no chain, doesn't make a difference. The focus in terms of para B is on the company A. Even if there is no chain, para 4B can apply to A. Even if there is a chain, para 4B can apply to A or B both. It can apply to A and B both. So if A is supposed to be investment entity, he will apply for B. If B is an investment entity, it can apply for B. Sir, does this mean that B can avail para 4 also and B can avail para number 4B also? Yes. Sir, if para number B, if B avails para 4, and B avails para 4B, 4 is giving a choice and 4B is mandating. Of course, I'll listen to para number 4B. Don't worry, I'll document this part as well. Very crucial indeed, but very interesting. So a parent that is an investment entity shall not present consolidated financials. So let's do one thing. At this stage, let's give you a clarification as well. We'll do a lot of questions getting this clear-cut understanding. So let me do one thing. Let me just make a clear-cut distinction between the para number 4 and the para number 4B as well, so we are very, very clear. So I am looking at the para number 4. I'm looking at the para number 4B. You need to be very clear on the distinction between the para 4 and 4B. What are the parameters? Is it mandatory? Is it optional? Whatever. First of all, we are looking at when does the para number 4 apply? There has to be a chain holding. There has to be a chain holding. So in this case, the para number 4 can apply only if there is supposed to be a chain holding. This can apply irrespective. This can apply irrespective. So irrespective, there is a chain or not. There is a chain or not. So it doesn't make a difference whether there is a chain or not. So just to give you a clarification at this stage, A has got stake in B and B has got a stake in C. B is going to apply para 4. In this particular case, we can say A has got stake in B. A can choose to apply para 4B. There is a chain, A is got in B and B is got in C. A can apply para 4B. B can also apply para 4B. I hope I'm very clear. So in terms of para number 4, it is only applicable in a chain to middle company. But when you're looking at the para number 4B, it is applicable whether there is a chain or not to the top company as well as to the middle company. So another moral of the story which comes into play is that company B can avail, you can say para 4 if it meets the 4 conditions, and it can also avail para 4B. It can avail any one of them, but we can definitely say that para 4B overrides. In this particular case, para 4B overrides para it overrides the para number 4. I hope I'm very crystal clear on the agenda. Because these are small little points, sometimes people tend to get confused in life. So I'm just giving you the complete essence in the chart so that you're very clear on the agenda. This is one area. And the second area in terms of the difference is, what is the status of this para number 4 and para number 4b? This is optional. This is optional. And this is mandatory. And this is mandatory. So this is the distinction in terms of para 4 and 4b. I hope, friends, I'm very clear, crystal clear on my thought processes, I guess. We'll work upon the para number 4b more in detail. So we've seen the para 4 and we've seen that the status is optional. Wonderful indeed. And the para number 4b applies in a chain or a non-chain. It applies to the top company and to the middle company, and it is mandatory. So if para number 4b applies to the company, I'll tell the company you cannot consolidate. If para number 4 applies, I say it's your choice. You want to apply, you can. You don't want to apply, you cannot. So let's go back to the inputs. And I want to go now to the para number 31 as well. It says a parent that is an investment entity shall not present console if it is required in accordance with para 31 to measure the subsidiaries at FPTPL. But we need to see some more details. So I am carrying the inputs of para number 30, 31, 32. And then we'll make some interesting inputs and do a lot of case studies as well. So this is now the para number 31, not 30, para number 31, 32, and 33. So let's read the further inputs out here. So now as you read the para number 4b, where the explanation is given in para number 31 onwards, you need to consider that this is called exception to consolidation. I would also like to give you some technical words at this stage. The para number 4 is called exemption, and the para number 4b is called exception. The para number 4 is called exemption, choice, and the para number 4b is called exception, mandate. So there is a difference between exemption and there is a difference between exception. I give you an exemption that you've got more than 60% marks in the paper, you're exempted to give this paper again, but you can disclaim and give the paper. Do you get the point? So when a student in the CA also gets an exemption, we say that you've got exemption in this paper. Out of the 3 papers in the exam, you got an exemption in one of the 3 because you got a 60% plus. You want to avail the exemption, you can. You don't want to avail the exemption, it's your choice. It's exemption, it's not exception. But para number 4b is a case of exception. I'm saying now you will not give the paper. That's exception. I hope you got the point. So the wording is exception. Except as described in para 32, investment entity shall not consolidate its subsidiary or apply 103 when it obtains a control of another entity. Instead, an investment entity shall measure the investments in a subsidiary at a fair value through profit and loss. So this company will measure its investments in subsidiary at an FPTPL. An investment entity is mandated that you cannot consolidate the subsidiaries. You can only show those investments in your separate financial statements at FPTPL, not even at cost. Then he says, notwithstanding the requirements in the above paragraph, if an investment entity has a subsidiary that is not itself an investment entity and whose main purpose and activities are providing services that relates to the investment entity's activity, it shall consolidate that subsidiary in accordance with the para number 19 to 26. What is he saying? Now friends, this para number 32 has got some very interesting connotations. And what I have done to make the life simple in terms of para number 32, I'm going to give you a 3-step model again. Oh my God. So get this very clear that when you apply the para number 4, we're going to look at 4 conditions. When you look at para number 4b, I'm going to look at a 3-step model. So your mind should be, clear like artificial intelligence, robo chitty. That's what I call people. That you should be very clear on the sequence of thoughts in life. That if it is not a case, when it is a case of para number 4, then what is your thoughts? 4 conditions. When it is a case of para number 4b, 3-step model. Let's see. I'll take an example now to illustrate this inputs in terms of para 32. Now please keep the chain in mind. Sorry. So let's again keep the chain holding in mind. We're looking at company A, we're looking at company B, and we're looking at company C. The para number 32 is supposed to be a clarification with reference to chain holding. As I said, the para number 4b applies when there is a chain or there is no chain. So para number 32 is giving you a clarification only when there is chain holding. So the para number 32, which is an exception to 31, is supposed to apply only when there is going to be a chain holding. Now, let's read the para again, and we're going to develop a 3-step model. I'll document that later, not a problem. I'll document that. So what it says, notwithstanding the requirements of para number 31, if an investment entity is got a subsidiary, let's say A is an investment entity. So it says if an investment entity has a subsidiary that is not an investment entity. So B is not an investment entity. B is not an investment entity. So you've got a subsidiary that is not an investment entity, and there is another condition, and whose main purpose and activities are providing services that relates to the investment entity. He is providing services which are related to the parent company A. He says whose main purpose is providing services that relates to the investment entity's investment activity. It shall consolidate. It shall consolidate. So if A is an investment entity, 1, if B is not an investment entity, 2, and number 3, B does the work which is related to an investment entity. Sir, can you tell us that if B is not an investment entity, why would it do something which is, an investment entity related activity? If it is doing an activity of investment entity, why did it not qualify to be an investment entity? I'll tell you. The standard has given us a plethora of, you can say, conditions with which you will decide it's an investment entity. Let me remind you. A group of unrelated investors gave me money. And with this, I invested in other companies as well. I will be qualified as an investment entity if I meet certain definition parameters and I meet certain characteristics of investment entity. And there is plethora of complicated conditions which will bring us to the conclusion whether the company is an investment entity or not. So there is a possibility that B is doing the work of an investment entity, but because of those definition parameters and because of those, characteristics of investment entity, he fails to meet the criteria of being called as an investment entity. So you could see that a particular company does activities quite similar to investment entity, but because of those stringent definitions and characteristics contained in the standard, there is a possibility that he does not qualify to be an investment entity. So the standard says that B is not an investment entity, but he does the work which is similar to the A. In that particular case, we should consolidate B. We will tell A that you please consolidate B. So let's move like this. Watch this. So I am going to go on step number 1, step number 2, and step number 3 to make life simple. In the step number 1, I'll put across a question. Is A an investment entity? Please watch this carefully. I'll document that later. I'll say, is A an investment entity? If you say no, it's not an investment entity, the para number 4B does not apply to him. The para number 4B does not apply to him because the parent is not an investment entity. So therefore, the para number 32 cannot apply to him. Therefore, the para number 4 and 32 cannot apply to him. So he is supposed to consolidate now. If you say yes, you go to the step number 2. So the first thing what you need to see is ask the question to the parent. Is he an investment entity? If the parent is not an investment entity, para 4B is not applicable. Para number 32 is not applicable. If you say it is an investment entity, then apparently para 4B applies. Now we are digging in terms of 32. And now we'll say, okay, is the subsidiary B supposed to be an investment entity? If you say a yes or you say a no. So first ask the parent, is it investment entity? Then ask the subsidiary, is it investment entity? If B is also an investment entity, you say yes, it is an investment entity. Consolidated financial statements not required, exempted. You are supposed to be given an exception. You will not consolidate in that case. So if A is investment entity, B is investment entity, in this particular case, consolidation is not required for A. But if you say that B is not an investment entity, you go to step 3. So go carefully step by step. A is an investment entity, go to step 2. B should not be investment entity, then you go to step 3. A is and B is not, then you go to step 3. So A is an investment entity, go to step B. B is not an investment entity because if it is investment, consolidation for A is not required. Then you put across the question, is B doing something which is related to A? Is B doing something which is related to A? The answer is a yes or no. If the answer is a yes, consolidate financials required. If B is doing something which is related to A, then it is required, even though it is not an investment entity, but it is performing the same work. It's like he does the same work, he does the same work, so apples with apples can be consolidated. But if you say that he does work of investment, he is not investment and doing something else, apples and oranges cannot be consolidated. So in this particular case, if the work is not similar, the consolidated financials not required. So can you just consolidate this once again? Let's put it once again. Get the chain in terms of para 4B. Para 4B is to be read along with para number 32. The para number which is given in 4B, but para number 32 is giving you more insights for chain holding. Para 4B is giving you a basic clarification. Parent is investment entity, that's it. But when it comes to a chain holding, the para number 4B is to be read with para number 32. Don't worry, I'll give you the chain very clear at this stage. So when you're looking at a chain holding in terms of para 4B, in this particular case, you need to apply a 3-step model. In terms of the 3-step model, you'll say A is an investment entity. No, A will consolidate. A is an investment entity. Let's go to step 2. Is B an investment entity? Yes, A will not consolidate. If B is not an investment entity, go to step number 3. Is B doing the work which is similar to A? If yes, ask A to consolidate B. If no, A will not consolidate. So get the chain clear. If he's not investment, do the consolidation. If he's investment, go to B and C. If B is also investment, don't consolidate. And if B is not investment, go to step 3. What does the work of B relates to? Same as A, consolidate. Not same as a don't consolidate. Let's, I think, pen this down and then let's do some more consolidation of things. I know, sounds complicated. Small little para number 4 and 4b and 32, but they can bombard your thought processes like anything. So let's do one thing. Let's now look at the case of, we can say, exception. Now we're looking at the case of exception, which is supposed to be para number 4b read with para number 32. So read with the para number 32. I'm just giving you these paras for reference later, so that if you want to get more clarity in terms of thoughts, you can apply your minds. So this exception is something which is mandatory. That's one. This is mandatory, as we said. And it is applicable to investment entities. It is applicable to investment entities. So we're looking at that this is going to be applicable to investment entities. At this stage, we're not considering what is an investment entities at this stage. So let me first of all give you what para 4b says. Then I'll give you what para number 32 states. So let's divide our discussions in two components. So we can see the two elements out here. When you're looking at para number 4b and when you're looking at the para number 32, para number 32 applies in chain holding. It applies to chain holding. So this is something which is in specific to the chain holding. After this notes, I'll give you a clarity again in terms of 4, 4b and 32, in which case to be applied. Summary. Then we'll do a lot of questions on this area as well. So para number 4b is something which is given in journal. It is given in journal. So we are looking at the para number 4b. So we are saying that parent, if the parent is an investment entity, I'll put it as IE. So let's put this as IE, investment entity. So we're saying that this is going to apply when the parent is an investment entity. Only then, we can say only then para 4b can trigger. It is only then that para 4b can trigger in this case. So the moment you say the parent is an investment entity, the para 4b will trigger in this case. So what am I supposed to do? No consolidated financial statements, investment in subsidiary measured at FPTPL. Investment in subsidiary is measured at fair value through profit and loss. So no consolidation will be done. That's a generic clarification given. But this applies when there is a chain holding, and in this particular case, we will apply a three-step model. We will apply a three-step model in this particular case. So this is the input. Now let's see what is the three-step model in terms of para number 32. Let's see para number 32. So in terms of para number 32, we're going to look at a three-step model. So we're going to go step by step in terms of applying the three-step model when it is a case of a chain holding. So in this particular case, let's keep in the background the example. A has got shares in B and B has got shares in C. So we're looking at, first of all, step number 1. We're looking at step number 1. Is A an investment entity? So the focus is A an investment entity? So the answer could be a yes or a no. So in this example, if A is yes an investment entity, you need to go to step number 2. And if you say no, A is not an investment entity, then A will consolidate. A will prepare consolidated financial statements. Then A is required to make a consolidated financial statements, even though he is supposed to be, because it is not investment entity, he gets nothing. is not able to avail para number 4 and 4B gone. Then you go to the step number 2. So in terms of step number 2, we can say, is B an investment entity? So the focus changes from the parent to the subsidiary. So first you ask the parent and then you ask the son. Sometimes I tell on a very lighter side, I remember the movie, I forgot the name, but this is a dialogue by Shah Rukh Khan, where he says in the movie, बेटे से क्या बात करता है बाप से बात कर. So the first step is that you talk to the father. So in this particular case, A is an investment entity, and then you put the question to the son. The first question goes to the father, then the next question goes to the son. So is B an investment entity? So we say a yes or we say a no. Now, if you say yes, then in that case, A is not required. A is not supposed to, I will not say required, is not supposed to make consolidated financial statements mandated. It's mandated. He's not supposed to consolidate. We're telling him you cannot. And if you say a no, then you go to the step number 3. Then you need to go to the step number 3 in this case. And in terms of the step number 3, we will now see what is the work which B does. Or rather we can say, is the work of B related to A? Is the work of B related to A? So we need to see, is the work of B related to A or not? So is B providing the same work which is provided by A? So the answer could be a yes or a no. So the answer could be a yes or the answer could be a no. If it is yes, apples and apples. So A will make consolidated financial statements. A will prepare consolidated financial statements. And if you say no, A will not prepare consolidated financial statements. So this is the chain of thought in terms of the para number 32, which is my 3-step model in this case. Wow. Now, I think at this stage it is necessary to do some icing on the cake. But I hope, friends, you've got the concepts very clear in terms of para 4, para 4B, and para 32. Great. Just to give you a little icing on the cake so that everything goes absolutely correct. And then we'll do some case studies, of course, after the break on that. But first, I think it's important to do some icing on the cake at this stage. So let's, I think, quickly, create a little mind map at this stage. The very important mind map which I'm giving you, it's a summary. So very, very important mind map in terms of the understanding we've developed on para 4, para 4B, and para number 32. Now, please hear this very, very carefully. I'm going to broadly divide my discussions in 2 parts. I'm going to broadly divide my summary in terms. So you will first look at the question and see that is there a chain holding or not. There is no chain holding, or we can say chain holding is there. So your first focus in the question is to see that there is a chain holding or there is no chain holding. This is like, combining now the inputs in terms of 4, 4B, and 32 all put together. So your first focus is to see, is there a chain or is there no chain? Now, when you say there is no chain, let's take the example A and B. Let's take the example A and B. I think let's put some questions also to you. Let's see how much you've actually understood so far. If there is no chain, can para number 4 apply, yes or no? I've already also, giving you the answer as well indirectly. So when you're looking at the case, there is no chain holding, can para number 4 in this case apply? So we're looking at the fact that in this case, can para number 4 apply or not? What do you say? Can para number 4 apply? You know the nitty-gritties.
No, sir.
That's absolutely correct. The answer is, of course, no, because para number 4 applies only when there is a chain. Only when there is a chain. Get this very clear. So in this case, A cannot avail para number 4. We're looking at things from the point of view of A. We're looking at things from the point of view of company A. Para 4A cannot apply. Let's look at para number 4B. Can para number 4B apply? What do you say? Yes or no? Can para number 4B apply to A or not if there is no chain? Yes or no?
Yes, sir.
Depends. Can I
Okay.
say if A is an investment entity? Yes. If no, then it cannot. Correct?
Yes, sir.
Correct. So we can say, I'll put it as depends. I'll say it depends. So we can say if A is investment entity, you say a yes, then para number 4 can apply. If you say no, then in that particular case, it cannot apply. I hope the chain is very, very clear indeed. By the way, let me also ask you another question at this stage, though it is not technically applicable, but still, is para number 32, can it apply? Can para number 32 apply to A in this case? Para number 32 also we said is a clarification when there is a chain. So do you think para number 32 can apply in this particular case? No. So I hope my position is 100% clear. When there is no chain, para 4 can never apply. Para 32 can never apply. It is only para number 4B. If A is an investment entity, then A will be given a mandate not to consolidate. Are we 100% clear? No chain holding?
Yes, sir.
Very good. Now let's look at the other case where there is a chain. Now watch this carefully. Watch this carefully. So we're looking at A has got a control over B, B has got a control over C. Now I'm going to look at things from two point of view. I want to see the point of view of A and I want to see the point of view of B as well. So I want to see the point of view from company A. And I want to see from the point of view of company B. Because this is super mind map summary, super mind map, where this can solve any question except one area which I have intentionally not told you so far. That will come to. Okay, now let's put some questions back again to you. In terms of A, can para number 4 apply? Yes or no? From A's point of view, can para number 4 apply? It's a chain, but is this para number 4 going to apply to A? Para 4 applies only when there is a chain and that also to the middle company. So can para number 4 apply to A? No.
No, sir.
Correct. Now let's see, can the para number 4B apply in this particular case to A? Para number 4B, can I say in this case, will be applied with para number 32 only. Am I right? The moment there is a chain holding, can I say A can apply for B only read with para 40, para number 32. Am I right? So is everything depends upon the three-step model, correct?
Yes, sir.
That's right. Everything will depend upon my three-step model in this particular case. Just to reiterate, I'll give you three cases. Tell me yes or not. A is investment, B is investment. Will A consolidate? A and B both are investment. Will A consolidate?
Yes, sir.
No.
No.
A investment, B investment, no consolidation. My three-step model. A is investment, B is investment, A is not supposed to consolidate.
Yes, sir.
So investment would be exempt. Let's see the next combination. A investment, B investment, B does not do the work of A. Will A consolidate? A investment, B not investment, B does something else not related to A. Will A consolidate? No. Third case, A investment, B not non-investment, B does the work of A. Will A consolidate? Yes. So everything depends upon the three-step model. Now let's look at the point of view of B. Let's look at the point of view of B. Now, can para number 4 apply to B? What do you say, yes or no? It's a chain holding, it's a middle company. Can para number 4 apply to company B?
Yes, sir.
Yes, definitely a yes. Okay, now we are looking at the concept that can para number 4B only apply to the company B. B is supposed to be investment entity in this particular case. Can I say again para number 32? Am I right?
Yes, sir.
Can I say the same status depends upon the three-step model in this case? It again depends upon the three-step model in this case. Now look at this chain very carefully in the break. This is, covering all kinds of permutations and combinations absolutely. But I'll still like to give you a focus back again out here. When you see a question, you need to first of all categorize, is it a chain holding or not? If it is not a chain holding, as far as A is concerned, para 4 is out of the picture. Para number 4B is again dependent upon the fact that in this particular case, it's an investment entity or not. And when you look at the para number 32, it cannot apply. The answer no is, very clear, because unless it is a chain holding, neither 4 can apply nor 32 can apply. So as a non-chain holding question, the focus is only on 4B. Are you an investment entity? Then no consolidation. If you're not an investment entity, then you consolidate. In terms of the chain holding, you need to be clear that it could apply to A and B. Now, if it is not a chain holding, then 4 can never apply to the top company. But 4 can definitely apply to the middle company. He cannot get para 4, he can get para 4. And then as far as 4B read with 32, all depends upon a three-step model. So spend some time, friends, on this mind map which I've given you and consolidate your fundas. What I'm going to do after the break, I will do now a lot of questions with you which are there in the study material. We are going to heavily look at the application of the scope of the standard. So I guess let's give you around a 12 minutes break or something, 10, 12 minutes. I'll join you after the break. Relax your minds, but spend around 2 minutes revisiting this chart as well so that you're absolutely clear before we do the questions with you. Enjoy your break. Thank you. So I hope you took a little time to look at this super summary chart which I gave you on the concept that whether it is a chain holding or not. And accordingly, we consider that in this particular case, whether para 4 would apply or not. So I think now let's start doing some questions with you. And just to give you a quick insight once again as we proceed. So as I'm going to look at the questions now with you, your first focus point should be very clear that is the question involving a chain holding or not. Remember, if there is no chain holding, one thing is very clear that the concept of para 4 or the three-step model cannot apply. So neither the four conditions will be seen nor the concept of three-step model will apply. So no chain holding makes the life very simple because neither we're looking at para 4 nor we're looking at the three-step model in terms of 32. The only focus would be that is A an investment entity or not. And depending upon whether it's an investment entity, we would simply consider a yes or a no. So if there is no chain, the life is very simple. The second case is when you focus that there is a chain holding, your focus would be that you're looking at A or you're looking at company B. Now, when you're focusing in terms of company A, para 4 cannot apply because para 4 applies only to the middle company. So this company would never apply para 4. Everything for A is dependent upon the concept, you can say, three-step model. So for the top company in a chain holding, three-step model is the focus point. And when you're looking at the middle company, he could avail the para 4, that is 4 conditions, or he would apply a three-step model and then take a decision. And if there is a contradiction in terms of para 4 or 4B read with 32, of course 4B would mandate. So we'll have to listen to what 4B applies in this particular case. So as we now proceed with the questions, please keep the chain very clear. No chain holding means only investment entity to be seen. Chain holding means that if it is top company, three-step model, middle company, 4 conditions, or three-step model, whatever the case may be. So I think let me just also overemphasize one part. In this case, the moral of the story is you just need to keep one focus point. That is an investment entity or not. That's it. No 4 conditions, no three-step model, just the focus on investment entity. In this particular case, the focus point is again on the three-step model. And if you're looking at the company B, the focus point is 2 things. The focus point is the 4 conditions, if it can meet, or the focus point is the three-step model. This is the moral of the story. I think I've tried to make your life even more simpler. That without a chain holding, your focus is it investment entity? With a chain holding, the focus point is three-step model. For the middle company, 4 conditions, or you need to consider three-step model, and the three-step model overrides the 4 condition. So far, so good. Let's now start with some questions in the study material with you. We're looking at the illustration number 1 in the study material. So let's have a look at illustration 1. And of course, as you're going to see questions, you'll of course see questions with a chain holding only. There's nothing to be seen if it is not a chain holding, because in that case, the focus is only, is it investment entity or not? So now let's go with the inputs. Scenario number A. Following is the structure of a group headed by company X. So I can definitely see a chain. My first focus is that I can see the chain. Now see, as I proceed on a step-by-step method, my first focus is that it's a chain. Now for company X, I know one thing, my focus is simply on a 3-step model. And if the focus is on company A, I'm looking at the 4 conditions, or I'm looking at the 3-step model, as the case might be. I hope my points are very clear.
Yes,
When
sir.
I'm looking at the top company, 3-step model comes into play. And when I'm looking at the middle company, the 4 conditions or the 3-step model, as the case might be. The company X has got a 100% stake in A. Company A has got 100% stake in B and C. Now let's see it further. Now let me tell you that in this particular case, I am given no information on the three-step model. I'm telling you in advance. In this particular case, in this illustration, there is no information which is given on a three-step model. Since there is no information on a three-step model, I cannot see things from the point of view of company X. I can definitely say that company X will definitely make a consolidated financial statements because three-step model information is not available. So companies A point of view, I just need to consider these four conditions only. I hope my chain is very clear. When you attack the question, you need to first of all zero down from whose perspective are you looking at things. So I can even convert this entire, para 4 for B and 32 in terms of another condensed three-step model. Shall I? If you want, I can condense it further into a three-step model as well. Shall I do the honors? Yes. Then let's make your life simple and let's give you another three-step model, which is, a super summary. I'm now looking at a super summary. So I would say when you're applying the concept of the scope of the standard, so whether it is a case of para number 4 or it is a case of para number 4B and a case of para number 32, the concept is going to be very simple. Step number 1. I would say in terms of step number 1C, is there a chain holding? Is there a chain holding? So first of all, get the focus clear that is there a chain holding? So your first focus would be to see that is there a chain holding or not. If you say that there is a chain holding, yes, or if you say no. Well, if you say it is no, then we can say we need to apply three-step model. We need to apply a three-step model, which I gave you earlier. For the top company, because it's simply A in B. If it is not a case of chain holding, this is the case A in B. And if it is a case of A in B, sorry, it's not a chain holding. Sorry, my mistake, not three-step model. So if it is a case when you say no, it is not a chain holding, the focus is only is a investment entity. The focus is only whether it's an investment entity. If it is yes, then consolidated financials not required. And if it is no, the consolidated financials will be prepared. Simple. Investment entity or not, no four conditions and no three-step models to be done. If you say yes, it is a chain holding, that means you're looking at A in B and A in C. Then I would say it's better to go to the step number 2. Let's go step by step. So we go to the step number 2. That makes life simple. So when you say that there is no chain, the focus is it investment entity? Done. When you say it is a chain holding, let's go to step number 2. And in step number 2, we need to see whose point of view. You need to see whose point of view are you analyzing things. Whose point of view are you analyzing things? Are you looking at from the point of view of A or B? So just identify, are you looking at A or are you looking at B? That's it. Just see whose point of view are you calculating things. That's all in step number 2. Then you go to the focus in terms of step number 3. And when you say the focus, you have decided that it is from B or C's, A or B's point of view, then what do? It is from A's point of view, then in that case, no four conditions. You just need to apply a three-step model. So if it is A's point of view, it is only a three-step model. It is only supposed to be a three-step model, which we did earlier. That's it. But if it is supposed to be B, then you can apply the four conditions also. You can apply the three-step model also. So in this particular case, you can see the four conditions also. Or if you're given the information, you could look at the three-step model also. And in this particular case, I think it is worth making a mention that the three-step model will override. The three-step model will override the decisions. So whatever conclusion comes under a three-step model, that is going to be the deciding criteria. I hope I've made your life more simpler. The focus is chain or not. The focus is whose point of view you're looking at. If it is the top company in third step, three-step model, middle company, four conditions, and a three-step model all put together. That is a combined super summary. Now let's come back and let's have a look further out here. So I've already made clear that if you're looking at this is a chain holding. So that was my step one, that there is a chain holding. I said, let me see whose point of view I'm looking at. If it is X company, three-step model, if it is A company, four conditions, or three-step, whichever is applicable. As I've already said, in this question, no data for a three-step model is given. Since no data for a three-step model is given, we can only look at things from company's A point of view. I cannot apply for company X a three-step. I cannot apply for company A a three-step. The focus is only four conditions. So we're going to put the four conditions. Is company A wholly owned subsidiary of X? Yes. So A is a wholly owned subsidiary of X, correct. A should not be listed. A should not be in the process of listing, and the company X should be making a console as per Ind AS and for public use. Let's read. It says company X is a listed company. That means it is preparing financial statements for public use. When it is a listed company, it proves that it is making financial statements for public use. And it prepares consolidated financial statements as per the requirements of Ind AS. So this proves my condition number 4. That the top company, that is company X, is making console as per Ind AS subcondition 1, and it is public use because it is listed. Company A is unlisted entity, not in the process of listing in the public market. Another two conditions met. The company A is not listed, not in the process of listing. Three conditions met. Company X does not object to company A not making console, though I think in this case, no objection is not required. Because in this particular case, we can say that this company is a wholly owned subsidiary, but of course, we can still say that yes, on a very apparent front, whether it is wholly or partly, let's still take the permission of the parent that he has got no objection that he does not make a console in this case. Whether company A is required to prepare a console as per the requirements of Ind AS 110. I would say it is his choice. Because you're applying the four conditions, so I would say he may or may not prepare in this particular case. So we can say he gets a choice. All the four conditions are met. He is under a complete choice to prepare them or not. Simple and straight. Let's go ahead. Then it says in scenario number B, same facts as in A, except that company X is a foreign entity. Now, if company X is a foreign company, it is listed in a stock exchange of a foreign country and prepares the financial statements as per the gaps applicable to that country. Can I say the fourth condition will fail in this case? If it is a company which is listed in a foreign company, it is definitely making console for public use, but not as per Ind AS. It would be following the applicable gap of that country. So I would say the fourth condition in this case will fail. And if the fourth condition in this case will fail, then what do we do in this particular case? Can I say consolidated financial statements are required to be made? Because in this particular case, you are not able to fulfill the conditions, so consolidated financials will be prepared in this case. Let's go to the next one. Now, this next one is something which I'm going to ask you. Assume the same facts in A, except that 100% of the investment in A is held by an individual instead of company X. Let's get your answers on that, friends. If the company on the top is not a company but an individual Mr. X, if Mr. X has got 100% stake in company A, would the company A be able to avail the choice under para number 4? I did not teach you that. Let's see, what do you say? So what do you say in this particular case? If on the top of the pyramid is supposed to be an individual and not a company, do you think in this particular case, the middle company will get the benefit of those 4 conditions? I did not show you something. I guess let me take you back on the original para to show you something interesting at this stage. Watch this. I am now looking at the inputs, what says in point 1. It is a wholly owned subsidiary or a partly owned subsidiary of another entity. The condition number 1 is very clear, that you need to be a wholly owned subsidiary of an entity, not an individual. So this condition is very clear, that when you're looking at a chain, it is A got shares in B and B got shares in C. It is B should be a wholly owned subsidiary of another entity. So if on the top of the pyramid is an individual, then this condition will fail. So we need to be careful that when there is a chain, for this particular condition, the clarification is that you need to be a wholly owned subsidiary of another company, of another entity. So let's come back on the agenda. So assuming the same facts, that A, instead of company X, it says individual is got shares in this company, then I would say the first condition will fail. In this particular case, the first condition will fail. Since the first condition will fail, here again, consolidated financial statements are required to be prepared. I hope, friends, this illustration 1 is absolutely clear. There was no application of a 3-step model, only looking at the 4 conditions from the middle company's point of view. Okay, this was first illustration, so I made a walkthrough. Now let's give opportunities to you. So we are going to look at illustration number 2. Let's see the illustration number 2 now. So I'm going to put the questions to you now. You decide. Scenario A, following is the structure of a group stake in B. It has got a 60% stake in C. Definitely see that there is a chain. So the first thing, I can definitely see that there is a chain. Now let me also tell you, in this particular case, I am given no data for the 3-step model. So there is no information which is given in the question for the application of the 3-step model. But still, let's get the chain clear. From company's A point of view, if you look at the focus, can I say it would be the 3-step model? But data is not given, so I can't see from A's point of view. And if you look at from company C point of view, it is the 4 conditions or it is the 3-step model. Both are applicable, but I will be able to look at only the 4 conditions. So my focus in this particular case is the company, the middle company in the chain. When I'm looking at the 4 conditions, are the 4 conditions for company C met or not? Let's, I think, begin with the first input. It says in this particular case, company A is a listed company. That means it is making financial statements for public use. And it is a listed company in India and prepares a consolidated financials as per the requirements of Ind AS. So my 4th condition is met. The company, which is the top company in the chain, is making a public use financials based on the requirements of Ind AS. Company C is an unlisted company and not in the process of listing as well. So I think another 2 set of conditions are met. It is neither listed nor in the process of listing. 3 conditions met. And then it says 60% of the equity share capital of company C is held by company A and the balance 40% is held by outside investor. 60% is with A and 40% is with others. and company A does not object to company C not making financials. Are all the conditions met? You tell me. Do you think all the conditions in this case is met?
Sir, here, however, all three conditions are met, but the first condition, the A does not have the wholly, a C is not wholly subsidiary of A. So the C is also required to take permission from the rest of 40% shareholders.
Wonderful indeed. In this particular case, since company A has got a 60% stake, he also needs approval of the NCI, which is 40% in this case. I am nowhere given whether the approval is given or not. If I say yes, they've given the approval, they've been informed, and they've got no objection, yes, he will get the choice in this particular case. So let's take it further. So that's what is given in the answer out here as well. I'm just reading the inputs on scene A. It says if other 40% equity shareholders are given and they do not object, only then they can avail the exemption in terms of making financial. Because as a parent, I would generally never object. If I'm a 100% owner in a company, I would never object. But I need to see that the NCI, they should also have a no objection. Now, scenario number B, assume the same facts except that the balance 40% of company C is held by company B. So now it says the 40% of this company is held by company B. He holds a 40% in this case. Do I now need the NOC of the NCI, the B? Remember, A is got 100% in B. So can I say through B, he's got a stake in C and directly in C? Get this
And
clear?
A will become the ultimate, the word.
Okay, so can I say, beta, in this case, that company A's approval is only required?
Yes, sir.
Because A is got directly 60 and indirectly through B 40. So
40%.
basically, he's got 100% now.
Yes, sir.
So we can say he's got indirectly 40 and then he's got directly 60. Since he's got direct indirect combined 100%, he can only give a no objection. We don't need the no objection of company B in this case. So in this particular case, it says company C is 100% held by A, 60% direct and 40% indirect investment through B. Hence, C is not required. You got some indirect percentage and ultimately you are having 100% stake in that company. So the company B in this particular case is supposed to be an NCI practically, but I don't need his approval because A is indirectly having 100% stake. Okay. So this was the second illustration. Now I guess we can take some interesting illustrations with you further. I have taken some more questions in the education material, 2-3 very interesting case studies further. Wow, so we've got one question number 6 from the education material and question number 7 from the education material. So now we're going to do some tougher questions with you. So watch this carefully. This is, a little better question. So this is in the education material. Question number 6. Now do the analysis carefully because this is now testing time. I've done the illustrations in the study mat. I'm now doing 2 case studies from the education material and let's get the fundas very clear. It says as per the para number 4A, that is condition number 1, a parent need not present consolidated financials if it meets certain conditions, and one of the conditions is that it is a wholly owned subsidiary or it is a partly owned subsidiary of another entity. And all other owners, including those not otherwise entitled, have been informed and they do not object to the parent presenting console. That was my condition number 1. Now let's look at the scenario number 1. I will first tell you in advance here again, I can clearly see that it is a case of chain. And let me also tell you that there is no information which is given on the application of investment entity. So there is no information on the basis of which my 3-step model can apply. So I'm keeping the 3-step model away. My first question is going to focus on 4 condition. My next question is going to focus on the 3-step model. Now, if I look at the status in terms of PQR, can you tell me what can be applied from a PQR's perspective? 4 conditions or 3-step model?
3-step model, sir.
Wonderful indeed. But since the information is not given, I cannot see from PQR's point of view. Next, I'm looking at AB and I'm looking at BC. What are the parameters to be seen for AC and BC? Which parameters?
4 conditions plus 3 steps.
Wonderful, 4 conditions and 3-step. But since I am not given a 3-step model, I will just look at the 4 conditions only. Let's begin the journey. We can see that AB is a wholly owned subsidiary of PQR. We can see that BC is also a wholly owned subsidiary of this particular company. By the way, the chain is a pretty longer as well. If the chain is a pretty longer as well, let me also ask you, what are you going to see from the company's XYZ point of view? Are they both middle companies?
Sir, it is apply 4 condition plus 3 steps and
Wonderful. Yes, same status as AB and BC. So I can only apply 4 conditions. So let me tell you in advance, this question is looking at this company XYZ. The requirement of the question is based on XYZ only. So let me first ask you a question. Does company XYZ need the NOC of company BC?
no, sir.
Wonderful. And what is the reason that he doesn't need the approval of BC?
Because the PQR Limited is the ultimate holder of the
Very good.
XYZ Limited.
Superb. So can I say PQR has got a indirect stake 60 through AB,
Yes, sir.
indirect stake 40 through BC. So he is the man who's got a 100% stake in XYZ. So I need a no objection only from PQR. I don't need a no objection in terms of BC. Great. So can I say if this company is not listed, 1, it is not in the process of listing, 2, and PQR has got no objection, 3, and PQR is a public entity making financial statements console as per Ind AS, I will give the choice in terms of company XYZ. Agreed?
Yes, sir.
Super. So let's read further. So we are given the scene number 1, and I guess let me just edit it out. So in this particular case, the question is asking us whether XYZ Limited can avail the exemption from the preparation. So it all depends upon the 4 conditions which we evaluated. So if you can meet the conditions that XYZ is not listed, not in the process of listing, and we know it is a wholly owned subsidiary of PQR directly, indirectly. In this particular case, a no objection from PQR is done, and PQR is a listed company and is making console as per Ind AS, he gets the choice. Now let's look at this scenario number 2. The facts are the same as above, that AB and BC are both owned by individual Mr. X instead of PQR. I guess let's directly put the question. Do you think XYZ will be able to meet the conditions? Think before you answer. I'm saying that the company AB and the company BC is owned by individual. So if on the top of the pyramid is an individual, will company XYZ be able to meet the conditions or not?
No, sir.
No, beta, think carefully. This time we are saying top of the pyramid is PQR, but there are companies here. There are companies here.
Yes, sir. Yes, sir.
Correct? So
Yes.
can I say in this case now, I would need the NOC, no objection for BC. Am I right? Because he is the parent of this company. It is partly owned by, you can say, company AB, and this is the NCI. I will need a information and no objection from the company BC. Had it been a
Yes, sir.
case of a company PQR, you don't need NOC from BC. But if it is individual, I need a NOC from BC. I hope the chain is clear. In the study material illustration, the chain was like this. If you just recall, the chain in the study material was like this. There was an individual, and then there was a middle company, and then there was a bottom company. Now, in this case, there was individual directly sitting on the top.
Yes,
The
sir.
condition number fails. But in this particular case, now you can see that there is an individual, but the chain has got extended. So there is a company, there is a company, and these companies have got in this company, and this has got in this company. So the role of individual got diluted because when you're looking at from this company's point of view, this individual only means I need a NOC from this. Had it been company, then I don't need a NOC from him. That's the difference. I hope you got the picture.
Yes, sir. Very much clear.
Wonderful indeed. So that was a very good illustration. That is why I added this question from the education material. Because apparently, if somebody has done that question in the study mat, he would immediately lead to a conclusion, individual, conditions not met. But we need to see that the individual in this chain is sitting on the top of the companies as well. Okay, so this is done. Now let's, I think, take it further. Now comes a very interesting question. So this was the answer which is shared. I guess let's go to this one now. Now this is another interesting question. Let's have a look at the question number 7, which is again in the study material. Here you'll see now everything. You look at the inputs in terms of the 3-step model as well as the inputs in terms of 4 conditions. Everything is contained. Let's begin. So I am looking at the following is the structure of a group which is headed by PQR. This is like the top company and this is like the middle company. So let's get one thing again clear. Can I say for PQR, I'm looking at the 4 conditions or not? No.
Top, it is three step
Yes, we're
model.
going to look at a 3-step model. And another question. Can it avail the para number 4B as well? Though it's non-investment? Can it be able to avail the para number 4B in this particular case, considering it is non-investment? So will it be able to get the benefit of 3-step? If you apply the 3-step, the parent is a non-investment entity. The very first step fails. Will it be able to get the benefit of 3-step? Yes or no? Am I right? No. Okay, I think we didn't do questions much on the 3-step. Let's get the chain clear. What was my 3-step? Is the parent investment? If you say no, go to the step 1 and see what is written. He is required to make a console. Correct? He
Yes.
is a non-investment entity. He cannot avail the benefit of the 3-step model. Gone. Okay, what about XYZ? Can he avail the 4 conditions? Yes. Can he get the benefit of the 3-step model? Yes. And now we are given inputs about the 3-step model as well. So in this case, 3-step model input is given. Now let's see. This company has got a 100% stake in XYZ, and this company has got 100% in A and 100% in B. This is a non-investment entity. This is a non-investment entity. And then it says the subsidiary of XYZ, it is carrying on services that relates to the investment activities of XYZ. Now let me ask you something. Are you going to apply a 3-step model for company A separately and company B separately or combined? You're looking at the question of the middle company consolidating these company. So will you evaluate the three-step model for A separately and three-step model for B separately? Correct. Yes.
Yes,
We
sir.
will
We will
evaluate the three-step
separately.
model separately. Correct. Now, let's make this clear. In view of the above, whether PQR and XYZ are required from the respective standpoint to present console, can I say PQR is definitely a yes? Because PQR cannot get the exemption under the three-step model, he will definitely have to present a console. We are now looking at XYZ, and I want to see the status whether he will consolidate A or not, and whether he will consolidate B or not. Now let me start asking questions to you, and you can vouch me. XYZ is investment entity. Let's go to the step number 1. Is XYZ an investment entity? Yes.
Yes, sir.
Let's go to the step number 2. Is A Limited an investment entity? No. So what do I do if the answer is no? Step 3. Now tell me, is the work which A does relates to XYZ or not? Yes or no? Is carrying on services relating to the activities of XYZ? So is A doing the work related to X? Yes.
Yes.
Tell me, is A required to be consolidated or not?
Yes, sir.
Yes. In this case, he will have to consolidate A Limited. Let's now go to B. So is XYZ investment entity? Yes. Is B Limited investment entity? No. Am I given any information about whether the services B is providing is relating to XYZ? So I presume it does not relate. Will he be consolidating B?
No, sir.
No, that's right. He will not be consolidating B, which means from the point of view of XYZ, he will only consolidate B and he will not consolidate A. To be very precise, we can say XYZ Limited, as far as the balance sheet is concerned, he will record A Limited at a fair value through profit and loss account. And as far as B Limited is concerned, it will be consolidated. So XYZ in any case will prepare a consolidated financial statements. But when he prepares a consolidated financial statements, he will not consolidate A, but measure the investments at a fair value through P&L. And as far as B is concerned, it will definitely get consolidated. But by the way, if I look at the status of PQR, is PQR required to consolidate XYZ as well as A as well as B? Am I right? Will he be able to record any companies at a fair value, or will he land up recording? Will he land up consolidating XYZ also, A also, and B also, correct? Yes. I hope the position is very, very clear now in terms of the scope of the standard. I think I've done team level of deeper discussions on the application of the scope of the standard.
Yes.
Wonderful. Great. I think now before we go forward in this particular case, let's get your inputs now in terms of your comfort zones. Let's get your scores on a scale of 10 before we proceed further. That's wonderful. It's 10 out of 10. That's great. Superb. Okay, now before we go further, let me just remind you the chain which I had given you in this particular case. So I'm just going to remind the chain what I gave you in this particular case as we proceed further. So let's come back on the agenda. So I'm now back on the issues which are arising in terms of Index 110. I'll just remind you that what is my approach, how I'm going to look at this standard, because now I need to create a chain of thought in terms of a control assessments. So what's this carefully? I have divided the standard into a total of 4 components. I've divided the standard in terms of 4 issue list. So we can see that there are a total of 4 issues which are covered under the standard. I've covered 1 issue today, and the first issue we've seen the clarifications regarding the difference between a principle-based and a rule-based assessment under the Companies Act, and we've seen that the definitions and other requirements of Ind AS will prevail. So I gave you first of all the concept of clarifications. And in terms of the clarifications, I gave you the clarification 1, that if there is a contradiction in terms of Companies Act as well as in terms of Ind AS, we've seen Ind AS will prevail. That was 1. Second important clarification which I also gave you was with reference to the fact that if there is a temporary investment, you acquire an investment in a subsidiary which is with a pure intention to make a sale. Under IGAP, it was not consolidated, but under Ind AS, it will be consolidated, but keeping Ind AS 105 into account. So in this particular case, we said the consolidated financials will be in accordance with Ind AS 110 as well as Ind AS 105. Then after the concept of the clarifications, I went on to the concept of the scope of the standard. And in terms of the scope of the standard, I gave you the inputs that in terms of the scope, we are looking at the application of para number 4 plus the para number 4B and the para number 32, in which I've given you already a 3-step model. We've done a detailed discussions on that. This was one area. Now let's come to the second area. This is the second area issue, which is called control assessment. The second area of issue is what is called control assessment. I guess if I look at the past trend in the exams, you may not see questions which have been asked in terms of control assessment directly as bigger questions, but of course in MCQs, one could definitely assess that. But I personally believe, even though that particular aspect is not really asked in the exams, but we should understand that process, because practically when you're going to become a qualified CA, you're definitely going to apply these concepts as well. So this control assessment is what we're going to now focus, which I've said is a principle-based assessment. This is a principle-based assessment. My third would be the technique of consolidation. My third area of discussion will be the technique of consolidation. And I think I like to throw a light at this stage itself. When I'm looking at the technique of consolidation, the technique of consolidation under 110 is called full consolidation. The technique of consolidation is called full consolidation. Now, when I say it's a full consolidation, it means that whether I get a control over the company with a 70% stake or with an 80% stake or with a 100% stake, I will aggregate all the assets and liabilities in the balance sheet. I'll aggregate all the incomes and expense in the balance sheet. So we need to learn the art of making a consolidated balance sheet and also learning the art of making a consolidated P&L as well. So we're going to spend a good time on the technique of consolidations, including the concept of chain holding as well. So in this particular case, when we learn the art of technique of consolidation, I will also give you the exposure in terms of if it is chain holding, how the consolidation is done. Lastly comes another area of discussions, and that area of discussion is with reference to what we call changes in ownership interest. That is called changes in the ownership interest. So when I say that there is a changes in the ownership interest as an investor, you would acquire more shares or you would even sell off the shares and the status could undergo a change. You can convert from a passive investor into a control, which you saw even in 103. Or you could convert from a significant influence to a control. Or there could be that you already have a control and you further acquire shares. So in this case, changes in ownership interest, we're going to look at the two agendas. One is a case of further acquisition and one is a case of disposal. So we look at certain permutations and combinations. How does the change in the ownership interest is going to make a difference in terms of consolidation? So this is the list of 4 issues which we need to keep in mind. Now I'm going to give you, first of all, the framework of control assessment. Of course, we will not be able to complete the control assessment at this stage. So I'm going to spend around a 10-15 minutes time giving you a framework of consolidation. We'll work upon this framework, but let me first take you to the chain of thought. So we'll take a lot of examples as we go through this process, but let's first get the framework for a control assessment. Let us understand the basic framework. I'm just giving you an understanding of the framework which is given in the standard. How do we do a control assessment? Now, please hear this very carefully. If you look at the standard, I made a mention earlier as well that there is no mention in the standard regarding a percentage criteria. It does not make a mention that you get a control over the company only when you acquire more than 50% stake. So they've given us some criteria which I've again converted into a step-by-step approach. I'm again going to give you a 3-step model in terms of deciding whether there is a control or not. So let's give you the framework of the 3-step model. So when I'm looking in terms of the 3-step model for deciding the control, my step number 1 is, let's imagine at the background, there is a company A and there is a company B, and A, we are assessing that A has got a control over company B. So let's keep at the background that company A, we are deciding, does it have a control over company B or not? The standard says that at the first instance, you need to decide, does A exercise a power over B? Now, let's not understand at this stage what is power, but just look at the sequence of the questions. I'll consolidate these inputs in the next session as well. But let's get the chain very clear. The standard says at the first instance, you need to, first of all, evaluate that does A exercise a power over B? Now, the question rises, what is the concept of power? Now, when you say that A exercises a power over B, I'll give you a further chain of thought as well. When you look at the concept of power, I'll give you certain sub-steps in terms of looking at the power. So within the step number 1, I'm going to look at another sub-steps, and here again, we're going to get 3 sub-steps as well. So we've got a sub-step number 1, sub-step number 2, and a sub-step number 3. So when you make the assessment that A exercises a power over B, you need to first of all understand that when you say that A is exercising a power, that A is exercising a power over B. Rather, I should not use the word power actually. I should actually, use another term. I'll tell you what. Because if you look at the standard, power becomes a sub-step technically. So I would say that the first inputs, what we should look at is, just give me a second. So in this particular case, I would say, yes, let's call it power only. So sub-steps would be that you look at what we call existing rights. So in terms of power, what you need to see is that there is an existing rights. So when you assess that A has got a control over B, the first thing is you need to prove that for a control, A is able to exercise a power. Power is an application based on certain existing rights. Now, there can be a variety of rights. We'll talk of all that in detail. I'm just creating a framework at the back of the mind. There can be a variety of rights which A has over B. And we can say majorly, when you look at the rights, there are 2 kinds of rights. One is called voting rights. So one is called voting rights. So we need to see that if we need to prove that A has got a power over B, A must have some kind of rights which are already existing. And these existing rights is that he's got voting rights in terms of B, or we need to prove that he's got the power to appoint or remove. He's got the power to appoint or remove the key management personnel. He has the right to decide who is going to sit in the board of directors of the company. because decisions by companies would be taken on the basis of the board of director. So we need to see that he may have rights in terms of controlling the majority composition of board of director, or he may have the right which is voting rights, or maybe both. It can be and or. The second input, what we need to see is, once you say that A has got existing rights, we need to see that these existing rights should give a current ability. These existing rights should give him a current ability. Now, many times people tend to get confused. And when they look at the word current ability, what comes to the mind is that as of now. But this current ability is not what we're going to look as of now. The current ability is going to be seen from a futuristic perspective. That A has certain rights which he may exercise when the need arises. So when you look at the concept of a current ability, we're looking at when the need arises. I have certain rights as an investor and I may not have exercised those rights so far. Mind the words. I have certain rights in terms of voting rights or the power to appoint or remove KMP, but I've not exercised those rights so far. But when the need arises, I will be in a position to use these rights when the need arises to exert my power. And when I'm going to use these rights, when the need arises, this should be to, you can say, to take, you can say, decisions on relevant activity. This should be to take decisions because of this right. The need arises to take decisions, and those decisions are on relevant activities. I'm just giving you a chain of thought on which we are going to work in our framework. So let me just put these thoughts once again at this particular stage. So what I am saying, when you are looking at the concept of a power, I am looking at the does A exercise a power over B? I will say, okay, let me put a question number 1A. Does A have some existing rights, either in the form of voting rights or in the form of appointment or removal of the KMP? And number 2, which will give him the ability when the need arises to take decisions on relevant activities. Now, what are relevant activities which could influence the profitability of the investee company? So when A has got some rights which will give him the ability to influence and take decisions on relevant activities, I will say yes, A has got a power. Next, this is the condition, the step number 1. Then we come to the step number 2. So we'll take a lot of examples. I'm still saying I'm just giving you a basic conceptual framework. I will rewind this particular conceptual framework in the next session as well, and we'll start working on each and every step and sub-steps as well. The second condition it says is that A is exposed to variable return. We need to see that A has got an exposure to variable returns. So if you can prove that A, with his involvement with the investee, if you can prove that A, with his involvement with the investee, is getting exposed to variable return. Now you would say, sir, when you invest in the equity stake of a company, naturally, you are always getting dividends, which is not fixed in nature, but it is fluctuating in nature. Agreed. So at this stage, if you want to keep the framework that A, by making investments in B, which is supposed to be equity interest, you are getting a return in the form of dividends, which is a variable return. So you need to be exposed to variable returns. And the step number 3 is what we call linkage. What we call linkage between power and return. The linkage between a power as well as a return. Basically, the linkage in terms of the step number 1 and in terms of step number 2, which means if you say there is a power and if you say yes, you're exposed to variable returns, automatically the linkage is got developed. If your answer to the step number 1 is a yes, the answer to the step number 2 is a yes, by default, your answer to the step number 3 is a yes. I have got the power, I am exposed to variable returns. The linkage between power and return is there. And in case you say that, yes, I've got a power, but no, I'm not exposed to variable returns, then there is no linkage in this particular case. So if you say a yes in this case, the control will arise. And in this particular case, there will be no control which will arise. So let me just quickly give you the framework once again, and we'll start working on this framework, of course, in the next class with you. But let's, I think, quickly consolidate the picture. As you can see, the control assessment under Ind AS is not at all a rule-based assessment. It is completely based on a principle-based, a judgment aspect. So there are three factors which you need to prove for a control. One is that as an investor, you've got a power over the investee. As an investor, you're exposed to variable returns with your involvement with the investee. And you need to prove a linkage between the step 1 and 2, that is power and the exposure to variable return. When you look at the concept of power, then there are three elements further to be seen. You need to evaluate that if A has got a power, prove it to me that he's got some kind of rights as of now. Existing right means he's got some kind of rights as of now. Then you go to the step number 2, where you see that these rights will be giving him the ability when the need arises, not as of today. The rights are there with him as of today, but he will be able to exercise those rights when the need arises, and he will be able to take decisions on relevant activity. So if A has got certain rights today, which will give him the ability when the need arises to influence the decisions on relevant activity, he gets a power. And then you see he is exposed to variable returns. Yes and yes means control is there. Yes and no, any one of the conditions fails, there is no linkage and there is no control. I hope, friends, you got the basic framework in terms of control assessment. We are going to work on this entire framework in detail in the next class with you. I hope you got the basic fundas clear. Correct? That's wonderful indeed. So I guess, friends, I am not working on this framework now because we don't have much more time. I'm not going to finish up things so fast. So we're going to continue with this particular concept in the next class video. So please do revise what we've done today, though what we've done today is not connected with the control assessment as well. But I would still say that for all these complicated topics, please spend time and keep doing consolidated revisions. But after I'm done with the control assessment, especially when we come to the consolidation techniques under this Ind AS, we definitely need accumulative revisions, because all the consolidation techniques is something which you need to bind, because we'll go to the consolidation technique, do some complicated adjustments also with you. Right, friends, so I think that's all for the day. Over to you for any questions on your side. So in start, the lecture feels some technical, but after you make it clear, it becomes very much interesting lecture. Thank you very much. That's what I always tell people. Things are difficult when they start, but of course, as you practice, it becomes easy. So trust me, you're going to get a good hang. If you revise clearly, you will definitely get a good hang on things. I know what I've done today is not been a very easy cakewalk as well. But yes, at the same time, it's very interesting indeed. So once you're going to revise this, you're going to get a complete strength on this particular aspect. Thank you very much indeed. Right, friends. So I think it's time to bid goodbye to you, friends. I am going to see you in the next class. Thank you. Bye-bye and take care. Thank you. Thank you. Thank you. Thank you.